Hey everybody, Sean Winkler here with Home Smart Realty in Mill Creek. Today I want to talk to you a little bit about the Deferred Sale Trust. If you want to just skip the information in this video and download the information right away, visit the link in the description below, dst.seanwinkler.com, and I'll email you that little presentation, little information about Deferred Sales Trust and how it works. Anyway, let's go ahead and get started here. So what is a Deferred Sale Trust? A deferred sale trust is basically a trust that purchases the seller's property and then resells it to the ultimate buyer. It allows the seller to treat the sale as a seller carryback transaction, where the buyer pays the purchase price over time. The language in the trust documents that the purchase documents between the trust and the seller cause the seller's income tax otherwise due on the sale to be deferred until the seller actually receives the money from the trust. After the asset is sold by the trust to the ultimate buyer, the trust may invest funds in any asset of their choice. There's no investment restrictions, there's no time frames for which investments are to be made. So unlike a 1031 exchange where you're on that 45, 180-day timeline, you don't have to worry about that because you can just park that money and let it work for you. So what types of assets can be sold using the deferred sale trust? Well, all kinds of assets. Just about any asset that's subject to capital gains taxation can be deferred with the deferred sale trust. These assets include rental properties, primary homes, commercial properties, private stocks and bonds, family businesses, and your insurance policies that need to be sold for cash. Most common types of asset sales using this method are the sale of real estate and the sale of a business. The deferred sales trust can even be sometimes used for other types of asset sales and transactions, including a 1031 exchange that would otherwise fail to be completed. It can be rescued by a deferred sales trust. The refinancing of a note receivable from a third party, and sales of marketable securities where there are restrictions on stock or limited trading volume of such stock. So you're probably wondering, when is the tax on the sale paid? Well, the seller sets up the timeline of when the payments will be made, both interest and principal, and the amount of each payment. The payments can be structured in any timeline and amount that the seller wishes. They can be interest only, with the principal amount paid in one balloon payment at the end, or where there are even payments made over the term of the structure. Regardless, the taxes on the gain are triggered when the principal payments are received. So capital gains rates in the year the payment is received is the rate applied to the principal payments as received. So the interest earned on the principal is taxed at ordinary rates in the year received. So now, what if you have multiple assets or properties that you want to sell over a period of time? Can the deferred sale trust work? And yes, it can. So one deferred sale trust structure will suffice for multiple assets sold over a period of time. However, planning is required for each asset sold at different times, and new documents must be executed. Each sale would require its own separate deferred sale trust note, but the same trust can be used. So the original fee schedule would apply to the sale of each additional asset added to the original trust with the preparing law firm. So I guess the best way to explain this to you would be that the deferred sale trust provides a means to sell your asset in a manner that allows you to get the tax benefits of a seller carryback type transaction. IRC 453 would be the tax code that we're working with here when you receive your payment, and you're taxed over time without sustaining the same level of risk that an inexperienced buyer or illiquid buyer may cause. Now, during this time period and until the installment payment is fully paid, your clients have the advantage of having a larger amount of cash working for them to achieve more value that selected installment period. With additional planning, the DST can be used in conjunction with estate planning devices to allow you to transfer your client's assets to the heirs, free federal estate tax, gift tax, and GST tax. So it helps you structure your way around these taxes that you might be facing down the road. Now, what is the total amount of assets that can be sold in a deferred sale trust per person per year? The seller or taxpayer, you, can create an installment note up to $5 million per person per year. So if you're married, then up to $10 million per calendar year can be sold using the deferred sale trust. If the sale is near the end of the year or beginning of the year, then action may be taken to spread that transaction across 2 calendar years, and you can double your amount there. Who can serve as trustee or manager, and what is the cost for the service? So we only allow professional fiduciaries to serve as the trustee. So they are independent third parties, can't be your brother, cousin, or anybody like that. Many people have used their family friend, an attorney, an accountant, or a combination of both using a co-trustee scenario. However, when co-trustees are employed, both the professional fiduciary as trustee and the co-trustee must sign off on any deferred sales trust transaction. This method allows for a checks and balances procedure that can provide another level of protection for the seller or taxpayer, such as you. Now, the deferral process works like this. The longer you can defer your installment payments, the longer your money can work for you and allow some incredible gains through the magic of compound interest. Now, that amount and timing of payments is something that should be discussed with the DST financial advisor and trustee. So that's something that you would set up based on your risk assessment profile. Is this an insurance product? You might be thinking it is not. Sometimes the general public becomes confused and thinks this is a structure sale with a commercial annuity type of product, but the Deferred Sales Trust does not involve insurance. However, commercial annuities and securities can be used as part of the investments inside the DST, but that's simply one investment option. Now, you're probably also wondering if you can get a loan against a deferred sale trust, and you can. So a seller and taxpayer can borrow against their note. Banks are always looking to make loans against assets, right? The DST note or the assets of the trust are assets that can serve as collateral for your loan. And we have banks in line that can be referred to you or your clients that want to make such loans. We can do that for you. What happens when you pass away, right? Succession, how do you plan for that? If the seller or taxpayer dies before the note is repaid, then the trustee will continue to pay the heirs of the seller or taxpayer until the note is repaid. Often the seller or taxpayer holds the note in their living trust, so the note will pass to their heirs without probate. And if you already have a living trust already, this is also fine. The living trust usually becomes the holder of the note, and thus the deferred sales trust note is transferred upon the client's death in the same manner as the other assets in the living trust. It's also included in your taxable estate. So the seller and taxpayer should know that the DST note will be included in their taxable estate just like any other asset. EPT will work with you, so the estate planning team, who I'm affiliated with, they'll work with you to educate you, the client, about your potential estate taxes. And if there are any estate tax problems, the EPT and the tax lawyers can help work to reduce your liability there. As far as protecting your assets go, the seller or taxpayer cannot rely on the deferred sales trust to protect their assets. However, the seller or taxpayer should know that the deferred sales trust is an asset that belongs to you and that a creditor can attach your DST note payments. However, creditors cannot touch the assets in the trust. Thus, the DST serves as a great deterrent against creditors because the only thing the creditor can get to is the payments to be made under the DST note per the terms of the note. Therefore, most creditors are willing to settle for far less after negotiating with you for a lump sum upfront. So why is it important to have a tax attorney close to the DST? And this is very important. You don't just want anybody unknowledgeable in this process to set it up. The seller and taxpayer need to be protected in doing tax savings transactions by tax lawyers who understand U.S. tax laws. Dealing with lawyers who specialize in implementing the DST will help your case close as they will understand the details of the deferred sale trust. We find so many lawyers and CPAs just don't understand the DST and don't have a strong tax background. That's where the estate planning team comes in, because each outside professional looking at the structure has to make sure that the deferred sale trust is a sound structure for their clients. The tax lawyer who specializes in the implementation of the DST is by far the best representation for you on every case. So that's it. That's a little bit about the deferred sale trust, how it works, why it's important, and how it might be able to benefit you. So if you want more information, just go ahead and click on the link in the description, dst.seanwinkler.com, and I'll email that information to you right away, and you can see if it's the best fit for you. Thanks so much for watching this video, and I look forward to hearing from you soon. Like and share, and leave a comment if you'd like to as well. Thanks.